Welcome, welcome, welcome. Good morning, good afternoon, good evening, and thank you guys for joining the 9 Innings podcast hosted by yours truly, Kevin Thompson of 9 Innings Capital Group. So there's a lot of things going on again. We talked about short sellers in previous podcasts. We've talked about taxes in previous podcasts. Now, markets are kind of going tipsy, topsy-turvy here. We don't know which direction they're going. But before we get started with that, don't forget to go to my website at 9inningscapitalgroup.com. Schedule an appointment if you have any questions about any previous podcast, any previous topic that we've discussed. We'll definitely love to have a conversation with you and schedule an appointment. Also, buy my book, MLB to CFP on Apple Books. Great read. But today, we're here to talk about three things: interest rates, the environment, the markets, what's going on. Let's get started. So let's talk about interest rates. Most people don't necessarily understand how interest rates really work. Yeah, they think they get from financing, from buying homes and things like that. And you're absolutely right on that. That is how interest rates work, right? However, when the interest rates in the market start to rise, it's a natural rate of kind of choking off the growth in regards to a lot of things in the stock market, a lot of equities in the stock market. Why is that? Well, typically when we value stocks, when we basically analyze stocks, we come out and we give them, we analyze them by using the risk-free rate. The risk-free rate is what you get in a government treasury because there is no risk of default. So depending on what you're using, whether you're using the 5-year, 10-year, whatever the rate you may be using, the risk-free rate, right now the risk-free rate was at or near zero. So if the risk-free rate is at or near zero, that means the discount rate on stocks has been relatively cheap. Therefore, stocks have been bid up because now they have a risk-free rate of zero. But what happens when the risk-free rate rises? Well, when the risk-free rate goes from 0 to 1 to 2 to 3, well, now your quote unquote, your value in stocks has to change. So now the risk-free rate is actually going up. So the value of those stocks either have to be you have to either overvalue those stocks and really believe in them, or B, bring down your expectations on your rates of returns that you can currently get, because now I can go into other parts of the market and get a risk-free rate of return that's higher than zero. So think about it that way from a logical perspective. If the risk-free rate goes from say 0 to 3, and your rate of return, your expectation on the stock that you're in is say 6%. Well, why would I invest in that stock if it's at 6% when I can get a risk-free rate of return at 3? So what you have to do is you have to revalue that stock and say, okay, instead of getting 6%, I need a 9, 10, or 11% because the risk-free rate is now 3%. So that's the simplicity of how that basically works and why interest rates kind of go against the market. But what did Jerome Powell just say? What did our guy in the Fed just say? Hey, we're going to keep this party going. We have Janet Yellen pouring more vodka in the punch bowl. We're staying here. We're here to party. So they're going to keep rates low for a long amount of time, for a longer amount of time. However, the natural rates inside of the market actually trying to say, hey, Jerome, that's bull. We don't believe you. And we're going to show you how much we don't believe you. Look at rates in the market right now. We're actually going to start bidding them up. We're going to start selling bonds and allowing the interest rates on those bonds to rise. So that's what you're seeing right now. You're seeing interest rates in the markets rise, which inevitably have caused the markets to kind of come down in the interim, depending on when you're watching this podcast. So one, interest rates going up. That is a good thing economically because typically you want to have rising interest rates. You want to have a good, strong economy. Typically, when the interest rates are going down, it's because you're trying to combat off a recession or a depression or something that's a slowing economy. You're trying to juice the economy. So right now, we're in a good spot where we are. Part two, inflation. Inflation. Mr. Powell keeps saying there's no inflation. Kevin, there is no inflation. I don't know what you're talking about. All I know is that my gas prices have gone from $1.99 to now it's $2.89 and here in Texas. Now I know that if gas prices go up, the cost of shipping goes up. That's inflation, right? Then the cost of shipping goes up. The costs of goods and services go up because that's quote unquote the natural rate of inflation. So if you're seeing right now what they're all thinking is that, well, inflation has not necessarily been here for a long period of time. We don't believe that it actually exists. By and large, it absolutely does. Especially here in Texas, we saw what inflation could do over a matter of days, especially when supply and demand kind of gets out of whack with gas prices. Now, I'm not talking about the petrol you put in your car either. I'm talking about gas that heats your house. So inflation is absolutely ticking up to a degree, and a lot of people actually believe it. However, the Fed remains steadfast on their current trajectory of interest rates. They're going to maintain their low rate of interest rates and continue to basically juice the economy. They want the economy to run a little bit hot, and they can always just raise rates. So they have a lot of arrows in their quiver to combat inflation moving forward. So we talked about interest rates. We talked about inflation. Let's just talk about the overall market in itself. Lots of volatility right now. We have certain stocks, like I mentioned to you before in previous podcasts, where we talk about short sellers, hedge funds, you name it. Man, it's doing it again, right? That Reddit trade is out there. We have a lot of individuals getting together and on these threads, bidding up stocks. Very, very intriguing dynamic. Very, very intriguing dynamic. And this new democratization of the markets will continue. It absolutely will continue. So look forward to that. Look forward to people getting together on forums, talking about certain stocks, going after those certain companies, bidding their prices up. I'm not saying they're manipulating them by any ways, but it does seem like there is some price discovery going on that needs to be addressed. So interest rates in the markets have been rising, causing the market to kind of come down because of the discount rate being changed, because the risk-free rate's moving up. Therefore, the risk on equities has kind of gone up to where you want to basically de-risk your portfolio and maybe go into a more of a risk-free environment. That's part one. Part two, inflation. There are hints of inflation coming right now because we do know what's going on. Prices are going up. Guess what else is going up? The salaries for most individuals are going up. So salaries as in to the employment, $15 minimum wage. That is something that they're thinking about doing and thinking about implementing. And most companies already have. Walmart has started that process. A lot of these companies have done that without even a mandate from the government. So that is something that the $15 minimum wage will be put forth if legislation passes. What else is going to happen? Well, if that legislation passes, $15 minimum wage goes up, guess what happens? Oh, natural rate of inflation. Now you have wage inflation moving higher. Price of goods and services go up. Now your price of everything that if you go to Starbucks, maybe your coffee's not I don't know how much coffee is at Starbucks. I don't drink Starbucks coffee, but let's just say if it was $1 at McDonald's coffee, now that coffee may be $1.25 or $1 and a nickel or $1 and a dime, something like that. So things will go up naturally from an inflation perspective. Expect that, especially when you have minimum wage going up, especially when you have the natural rate in regards to interest rates in the markets moving up, and especially when you have things that are outliers in regards to our economy, supply and demand and things like that. Like, for example, in the chip sector, there's a demand for chips right now, but a supply has been limited. So what happens? The price goes up. These stocks have been bid up, right? These stocks, I'm not going to name any names because I want to get from a compliance perspective, but these stocks have been bid up because the supply has come down and demand is so high. And now, boom, guess what? These stocks have been bid up because of that. And then what happens when those prices of those goods, prices of the chips that they go into your iPhone or your Android device, what happens to the price of your Android or iPhone device? It goes up. So inflation is there. It just is not necessarily there to a point where the Fed thinks it's something that needs to be addressed at this time. Hey, I hope this has been a valuable use of your time. I love talking about some things like this. Today, we talked about interest rates, inflation, and markets. I love these conversations. This was a quick synopsis of what's going on right now. This is Kevin Thompson, 980s Podcast. Go buy my book on Apple Books, MLB to CFP. Thank you guys for joining us today. Thank you guys for all the comments and love that you've shown us. We appreciate it. Stay safe. God bless.